Ever feel like your money's just not going as far as it used to? Or maybe you're scratching your head trying to figure out how these big economic headlines, inflation, interest rates, actually hit your wallet, affecting your savings, your investments, maybe even your mortgage. Yeah, you're definitely not alone there. It can seem like a real puzzle trying to connect those global trends to your own personal finances. Well, today we're going to cut through some of that confusion. We're taking a deep dive into the nuanced relationship between inflation and your money, whether you're investing it or borrowing it. Our mission today: unpack how inflation fundamentally impacts your financial picture. We're drawing insights from some really comprehensive source material we've got here. It's all about getting you to that aha moment, kind of quickly and clearly. Before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive counting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, let's unpack this then. We hear inflation thrown around all the time, but what does it really mean for us? At its core, inflation is just, a general increase in the prices of goods and services over time. Pretty straightforward. And its most crucial effect, it basically erodes or reduces your purchasing power. Think about it. That same $20 in your pocket today probably won't buy you the same amount of stuff next year. It's like your money's on a slow diet, getting lighter.
Well, that's exactly right. And what's really fascinating here is that while inflation hits everyone's purchasing power, it affects different types of financial instruments very differently. We're looking at two main categories today. First, debt investments. That's basically when you are the lender, like buying bonds or maybe getting fixed annuity payments. And second, debt itself, the money you borrow. These are distinct things, and inflation treats them very differently. The key variable, really, it all boils down to whether the interest rate is fixed or floating.
Okay, so let's start there. Let's put ourselves in the lender's shoes first, looking at fixed rate debt investments. When we say fixed rate, it means exactly what it sounds like, right? An investment where the interest rate is set in stone, predetermined, unchanging. Imagine a bond that promises you a steady 6% return year after year. Seems predictable. The source material has this brilliant little illustration, the cup of coffee example, to help grasp this. Imagine you've invested some money and you're getting $6,000 in interest each year from this fixed rate thing. In year one, let's say a cup of coffee costs $2. So your $6,000 buys you what, 3,000 cups of coffee? Nice. But now let's jump forward. Inflation kicks in, maybe significantly. You're still getting that exact same $6,000 because, well, it's fixed. But that cup of coffee, now it costs $3. Suddenly, your $6,000 only buys you 2,000 cups. The number of dollars hasn't changed, but the real value, what those dollars actually buy, has clearly taken a big hit.
Precisely. And this is where you see the market consequences. When inflation rises, any new bonds coming onto the market have to offer higher rates, maybe 8%, maybe 10%, instead of your original 6%.
Right, because lenders need more to compensate.
Exactly. They need to protect your own purchasing power.
Right.
So if you're holding that 6% bond, why would anyone buy it from you when they can get a brand new one paying 8%? The direct result. The market value of your existing fixed rate bond goes down. It's just less attractive.
Okay.
Now, conversely, and this is important too, if inflation were to decrease, suddenly your bond paying that higher fixed rate looks pretty good compared to new lower rate bonds.
Wow.
So its market value could actually increase.
Ah, interesting.
But the main takeaway, especially when inflation is rising, is that the real return on these fixed rate investments goes down. The nominal payment is the same, but its purchasing power shrinks. It's like a silent thief.
That's a really clear way to put it, the opportunity cost of holding on to the lower rate. But okay, not everything is fixed rate. So if fixed rates suffer when inflation goes up, are there investments that, do better? Or at least hold their own?
That's a great question. And yes, absolutely. That's where floating rate investments come in. These are structured differently. The interest rates aren't fixed. They reset periodically, maybe every 3 months, maybe 6 months. They're usually tied to some kind of benchmark, like LIBOR, though that's being phased out, or maybe U.S. Treasury yields, something that reflects current market rates.
Okay, so they adjust.
Right. The idea is if inflation and overall interest rates go up, the rate on your investment goes up too. So instead of getting that fixed $6,000 we talked about, your payment might adjust upwards to, say, $7,000 or more. That adjustment mechanism helps mitigate the erosion of your real return. It's designed for that.
I see.
And some instruments are even specifically designed for inflation protection. A key example in the U.S. is TPS, Treasury Inflation Protected Securities. With TPS, the actual principal value adjusts based on inflation changes. So the investment itself sort of grows with inflation, aiming to keep its real value steady.
Wow. Okay.
But there's always a but, right?
Oh, always.
With any floating rate, including TPS, if inflation goes down, your return will also likely go down. It works both ways.
That makes sense. A two-way street. Okay, that's super helpful for the investment side. Now let's flip this around. We've looked at being the lender. What happens when you're the one who owes money? When you're the borrower? This is where sometimes things can look surprisingly different. This is where it gets really interesting for a lot of people. Let's talk about new borrowing first. When inflation kicks in, what do central banks usually do?
They raise interest rates.
Right, like the Fed raises rates to try and cool the economy down, and that means higher borrowing costs for, well, pretty much everyone. Individuals getting a mortgage, businesses needing loans, even governments issuing bonds.
Mm-hmm. Lenders demand higher returns on new loans, like we said, to protect their own future purchasing power from being eroded by that inflation.
So, bottom line, if you're borrowing new money or refinancing during inflationary times, you're probably facing higher interest payments. It's just more expensive to borrow.
Definitely tougher for new borrowers.
Mm-hmm.
But this is where it gets interesting for existing debt, especially fixed-rate debt. This is where the dynamic can shift, sometimes dramatically, in the borrower's favor.
How so?
Well, think about it. If inflation increases, the real value of your outstanding fixed-rate debt actually decreases. Let's use the sources example again. Say you borrowed $100,000 at a fixed 6%. That's a $6,000 annual interest payment, fixed. Maybe your income was $70,000 when you took out the loan. Now inflation's up. Maybe your boss gives you a $5,000 raise to compensate, so you're making $75,000.
Okay.
But your debt payment, it's still that fixed $6,000. That hasn't changed.
I see where you're going. You're earning more nominal dollars, but the payment stays the same.
Exactly. That fixed $6,000 payment becomes a smaller percentage of your larger income. It represents a smaller real burden. You have more nominal cash flow to cover that same fixed payment. Psychologically and financially, it feels easier to manage. The debt effectively shrinks relative to your income.
That's actually a pretty significant benefit for the borrower.
It can be, but who's on the other side of that?
A lender.
Right. The lender is the one losing purchasing power here. They're still getting their $6,000, but those dollars buy less than they did when the loan started. That's precisely why they want higher rates on new loans when inflation is high, to avoid this exact situation in the future.
Makes perfect sense.
Now, there's a huge caveat here, a really critical one for listeners.
Okay.
This advantage for borrowers, it only really works if your income, your wages, is keeping pace with or ideally exceeding inflation. If your income isn't going up much, but prices for everything else are, then even though the real value of your debt is technically lower, that fixed payment can still feel incredibly heavy because your overall budget is squeezed.
That's a crucial point. So income growth is key to actually feeling that benefit.
Got it. And what about variable rate debt? If you borrowed with a rate that floats?
Yeah, with variable rate debt, the lender is much more protected. As inflation pushes overall interest rates higher, your loan payment adjusts upwards because it's tied to those benchmarks we mentioned earlier.
So the borrower pays more.
Correct. The lender receives higher payments, which helps offset their loss of purchasing power from inflation. It basically shifts the inflation risk from the lender to the borrower in that case.
Fascinating stuff. Okay, so we've really broken down how inflation messes with investments and debt based on fixed versus floating rates. Knowing all this, how do we actually, protect ourselves? What specific kinds of investments are actually designed to guard against inflation? What should people look for?
That's the practical question, isn't it? What can you actually do? Well, an inflation-protected investment is basically anything whose value tends to move proportionally with or ideally faster than inflation. The source material points to a few classic examples.
First up, commodities. Think things like gold, silver, maybe other metals, oil. Historically, these have often acted as a hedge. When the cost of everything else is rising, the value of these real things often tends to rise too. They're tangible. It's not always a perfect correlation, mind you, and they can be volatile, but the general trend can provide some protection.
Okay, commodities. What else?
Second, real estate. Buildings, land, these are tangible assets that tend to increase in value over the long term, often keeping pace with or exceeding inflation. And if it's income-producing real estate, like a rental property, you can often adjust the rent over time to keep up with rising costs, protecting the income stream too.
Right, you can raise the rent. Makes sense.
Third, things like livestock and agricultural products. Similar to other commodities, their prices generally rise as overall consumer prices go up. If the price of tomatoes or beef is rising in the grocery store, the producers of those goods are likely able to charge more, protecting their own position against rising costs.
So a pattern emerges.
Yeah.
Tangible things.
Pretty much.
Yeah.
When you're trying to identify these assets, a good rule of thumb is to look for real things. Physical assets, or assets that generate income that can be adjusted for inflation. Basically, anything whose value inherently tends to increase along with or faster than the general price level could be considered inflation protected to some degree.
This has been incredibly helpful, really breaking it down. So just to recap the big picture, inflation isn't just some abstract number. It's a real economic force. It fundamentally shifts the real value of your money, your investments, your debts. And whether those things have a fixed rate or a floating rate, that's absolutely crucial. It determines who benefits and who, well, takes a hit. So considering all these different impacts we've talked about, maybe take a moment to think about your own situation. How might your current financial holdings, your investments, and your debts actually perform if inflation stays high or changes significantly over the next, say, decade? Are there maybe small tweaks or changes you could explore in your portfolio or even your debt structure to better align with these principles, give your financial future a bit more stability? It's worth pondering, right? Not about panic, just strategy.
Exactly. And thinking about it is the first step. You understand it now, which is great. But the real learning, the kind that really sticks and empowers you, comes from actually applying it, from practicing. The source material strongly advises this. Go to farhatlectures.com, look at the additional multiple choice questions, the exercises they have there related to these topics. That's going to really help you practice and solidify what we've just discussed in a really practical way. It's about investing in yourself, maybe investing in your CPA exam if that's your goal. So good luck with it, study hard, and stay safe out there.